Welcome to the pit. I'm Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the Singapore GX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. Is a 7.5% yield a sanctuary for your retirement or a siren song leading to a trap? In this market, the difference between long-term safety and a permanent loss of capital is decided before the opening bell, not after the damage is already done. Today we are conducting a forensic audit of CapitaLand Ascendas REIT to see if this massive expansion is a masterstroke or a watchlist trigger for your portfolio. We are looking at what I call the 2.35 Singapore dollar binary trap. Currently, the manager is looking for a 1.41 billion Singapore dollar expansion. On one hand, you have a tactical discount that looks attractive to the untrained eye. On the other hand, you have a 42% pro forma gearing ratio that is a ticking clock on the balance sheet. For the heartland investor holding this for income, the choice is simple but dangerous. You either subscribe or you face permanent dilution. If you are holding this REIT for long-term income in your CPF or SRS accounts, you are standing in a binary trap. This audit is designed to reveal exactly what is being hidden beneath that headline yield. We are going to look at the gearing, the occupancy gaps, and the debt overhang that the market is currently pricing in. By the end of this session, you will know whether to step into this expansion or stay on the sidelines while the institutions move in. The crash we have seen recently was not a surprise to those who follow a forensic framework. In the Singapore market, the red flags are always visible if you know where to look. The question is never about what happened yesterday, but whether you had the tools to read the signals in time. This is about moving away from chasing headlines and moving toward a framework that protects your hard-earned savings before the volatility hits. Before we dive deep, remember that Iggy's elite investors did not chase that headline yield blindly. They had the full forensic breakdown, including the gearing ratios and debt overhang, before the market even opened. For 9 Singapore dollars a month, which is less than a kopi and kaya toast set at Raffles Place, you can stop being the exit liquidity for big players and start being the analyst. Join the elite investors today to get your 0-day reports and institutional-grade cheat sheets. To understand this REIT, we must use my 5-layer analytical floor. This is my personal standard for tracking Singapore real estate, and it begins with a floor of 3.2%. This is based on the opportunity cost of your capital and the CPF special account benchmark. For a titan like this, we audit for the storm, not just the sunny days. Because multiple forensic thresholds have been breached simultaneously, the full 5-layer treatment is mandatory for this audit. Layer 1 is the raw fact. The gearing is projected to hit 42%. Layer 2 is the benchmark, which severely breaches my forensic ceiling of 35%. Looking at Layer 3, our peer context shows that Mapletree Industrial Trust is at 37.2%, which is safer than what we see here. Layer 4 gives us the forward scenario. If interest rates stay high through 2027, we could see a distribution contraction of nearly 1 cent. Finally, Layer 5 is the wallet impact. For a retiree in Toa Payoh, this represents a potential 5 to 8% reduction in annual cash flow if rental growth slows down. Now we move to step 1, the health check. We are looking at solvency, and right now 3 forensic metrics are failing at the same time. This is not just market noise, it is a pattern that suggests the dividend math could break if the manager loses pricing power. While the interest coverage ratio remains at 3.6 times, it is below my 4.0 threshold for a fortress balance sheet. When multiple indicators fail at once, it means the buffer for error has effectively disappeared. Let's decode these red flags. Gearing at 42% tells us how much of the portfolio is owned by the bank. While this is within the regulatory limit of 50%, it leaves almost no room for property values to drop. If values dip by just 10% in a global slowdown, the REIT enters the danger zone. Furthermore, the interest coverage ratio of 3.6 means the buffer is narrowing. A fortress ratio ensures that even if half the tenants stop paying, the bank does not come knocking on your door. This brings us to a critical insight regarding the non-renounceable trap. This type of offering is fundamentally coercive because you cannot sell your rights on the open market. If you fail to subscribe, you are essentially forfeiting an 18-cent premium per unit directly to the underwriting banks. This is not just an investment choice, it is a defensive necessity to prevent your equity from being diluted. In a non-renounceable rights issue, doing nothing is the most expensive decision a heartland investor can make. In step 2, we perform the wealth check by looking at the yield trajectory. If you look at the 3-year history, the distribution per unit tells a story of a flat to declining trend even before this new fundraise. We have seen a slip from 15.2 cents down to 15 cents. While distributable income actually rose, the dip was caused by unit-based dilution from a previous fundraise in May. You must be careful not to confuse trailing yields with pro forma projections. It is vital to read the distribution decline correctly. The current trailing yield at a price of 2.51 Singapore dollars is actually around 5.98%. That headline 7.5% figure is a forward estimate that only becomes real if the new acquisitions deliver their full projected growth. If those acquisitions do not hit their targets, that 7.5% number will be the first thing the market revises downward. There is also a one-off advance distribution of 3.75 cents that you need to be aware of. This payment covers the period from January to April of 2026 and is being paid specifically because of this fundraise. It is not a regular semi-annual payment. Crucially, if you are subscribing to new units, you do not qualify for this specific distribution. When calculating your year one yield, you must exclude this amount entirely or your math will be wrong. For this audit, I am applying a stress test buffer with a minimum hurdle of 4.7%. My personal floor stays at 3.2% because I do not lower my standards just because market rates dip temporarily. We want our sanctuary assets to be able to withstand a return to long-term average interest rates. If an investment cannot clear this hurdle with a mandatory risk premium of 150 basis points, it does not belong in a forensic-grade portfolio. This is what I call the MRT Door Paradox. Even as the crowd is pushing to get out of certain sectors, the demand for prime industrial space is so strong that the manager can keep raising the ticket price. We see rental reversions of 9 to 12%, which is impressive. However, the 7.5% yield depends entirely on organic growth from the new Osaka and Loyang assets. The moment that rental growth weakens, the entire bull case for this yield starts to crumble. Alright, favor to ask all of you, could you check right now if you've hit the subscribe button if you watch this channel regularly and you get value from what we do here? We're approaching a big milestone for Iggy in terms of subscriber numbers. So if there was one simple thing you could do to support the channel, whether you're a free viewer or paid member, it's just to hit that subscribe button and double check you've hit it. It helps us keep delivering sharper, more relevant analysis week after week. In step 3, we look at the price check and the valuation gap. There is a massive difference between what analysts claim and what the market is actually doing. Until the balance sheet optics are resolved, this gap will remain. When we compare this to peers, we see that the market is pricing this REIT like a distressed play because of that 42% gearing. Meanwhile, Maplet Tree Industrial Trust trades at a similar price-to-book ratio despite having a much safer balance sheet. Currently, there is a theoretical upside of over 25% if you believe the institutional consensus fair value of 3.18 Singapore dollars. The portfolio quality is high, with over 200 properties across 4 continents, including mission-critical data centers. However, the market will likely keep this valuation discount in place until management can prove they can bring the net debt to EBITDA ratio back down towards 7 times. Right now, it stands at a heavy 8.6 times. Let's use some Copitium Logic here. Buying this REIT at $2.53 is like buying a premium fair price house brand product at a 25% discount because the box is slightly dented. The content inside is still high quality, but the dented balance sheet makes shoppers nervous. That nervousness is your entry window, but you have to be comfortable holding a product with a few visible bruises on its financial statements. Step 4 looks at the pivot into 1.41 billion Singapore dollars worth of new assets. This fundraise is not about defensive survival. It is an aggressive move out of legacy industrial assets into high-tech logistics. For example, the Loyang cluster acquisition is a bet on the scarcity of ramp-up facilities. In these buildings, heavy vehicles drive directly to the upper floors, which is critical for logistics providers who need to save every second during loading. Then we have the Osaka entry, which is the most structurally significant part of this deal. By taking a 49% stake in a Japanese hyperscale data center, the manager is buying into the technology age. Once a cloud provider moves into a facility like this, the cost to migrate elsewhere is prohibitive. This creates a sticky, long-duration revenue stream that is much more reliable than traditional warehouse rent. The Japanese move also provides a natural hedge. 76% of the debt is denominated in yen to match the assets, protecting you from the currency volatility we have seen in US dollar portfolios. Additionally, these are triple net structures. This means the tenant, not you, pays for the surging utility and energy costs. Sophisticated capital recycling like this converts industrial noise into a mission-critical sanctuary where the tenant picks up the energy bill. Before we look at the final forensic verdict, remember that Iggy's elite investors had this full breakdown before the opening bell. If you want zero-day access to our red zone watchlist and institutional-grade cheat sheets to avoid being the market's exit liquidity, click the link in the description to join our community today. Now we reach the bottom line. For a heartland investor, this is a trade-off between a discounted entry and a balance sheet risk that cannot be solved with a simple pass or fail. I am officially classifying CapitaLand Ascendas REIT as a firm watchlist trigger. The breach of my gearing ceiling and the failure of the interest coverage ratio are red flags that we simply cannot ignore, regardless of how much we like the underlying properties. However, I want to be clear, this is not a yield trap. A yield trap happens when distributions are paid out of shrinking earnings. Here, rental growth is above 12% and the business is clearly expanding. The high leverage is a consequence of ambition and rapid growth, not financial distress. It is a calculated risk taken by management to secure a dominant position in data centers and high-spec logistics for the next decade. For an investor in Clementi holding 30,000 units, the dollar consequence is real. Ignoring this offering means a permanent loss of 18 cents in value per new unit to the underwriting banks. Participating at $2.35 is like averaging down into a $20 billion portfolio that is currently under renovation. The scaffolding might look ugly right now, but the finished floor plan is much stronger than the current stock price suggests. The final forensic position is direct. Subscribe to your rights to secure your discount. Do not let the underwriters take your seat at the table. However, you must keep the interest coverage ratio on a tight leash. If that ratio slips toward 3.2 times, the sanctuary is compromised. Until then, you are buying the region's largest industrial landlord at the same price the big institutions were prepared to pay. Scaling a fortress requires capital, and the manager is asking for yours to finish the job. If you found this forensic breakdown helpful, remember that the free version of these reports usually comes with a 7-day embargo. Iggy's elite investors get these insights the moment they are finalized, along with full access to the Red Zone watchlist. If you want to stay ahead of the curve and protect your retirement portfolio from the next market shift, click the link in the description and join us. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.